Supply and demand indicator, best price action indicator. Supply and demand are two fundamental concepts in economics that determine the price of goods and services. In the financial markets, the supply and demand indicator is a popular tool that traders use to identify potential price reversal points based on changes in market sentiment. In this blog, we will discuss why the supply and demand indicator is the best price action indicator and how traders can use it to improve their trading performance. What is supply and demand in trading? Before we dive into the supply and demand indicator, let's first define what supply and demand mean in the financial markets. In simple terms, supply refers to the amount of a particular asset that is available for sale at a given price, while demand refers to the amount that buyers are willing to purchase at that price. The relationship between supply and demand determines the market price of an asset. When there is more demand than supply, the price of an asset will rise, and vice versa. Understanding the dynamics of supply and demand is crucial in trading because it helps traders identify potential price reversal points based on changes in market sentiment. What is a supply and demand indicator? A supply and demand indicator is a technical analysis tool that displays potential supply and demand zones on a price chart. These zones are areas where the market may reverse its direction due to changes in market sentiment. The indicator looks for areas where price has previously experienced a surge in buying or selling pressure, indicating the presence of a significant supply or demand zone. There are several different supply and demand indicators available, including the liquidity zone indicator, the volume profile indicator, and the market depth indicator. Each indicator works slightly differently, but they all focus on identifying areas where the market could potentially reverse its direction based on shifts in supply and demand. Why is the supply and demand indicator the best price action indicator? The supply and demand indicator is often considered the best price action indicator because it focuses on the most fundamental concept in trading, supply and demand. Unlike other technical indicators that rely on mathematical formulas or complex algorithms, the supply and demand indicator is based on market sentiment, which is the driving force behind price movements. By focusing on supply and demand, traders can identify potential price reversal points with a high degree of accuracy. These areas are where traders can enter or exit trades based on strong levels of buying or selling pressure, providing them with a high probability trading opportunity. How to use the supply and demand indicator in trading? Now that we understand what the supply and demand indicator is and why it's the best price action indicator, let's discuss how traders can use it in their trading strategies. Below are some tips on how to use the supply and demand indicator effectively. 1. Identify high probability trading zones. The first step in using the supply and demand indicator is to identify high probability trading zones. These are areas on the chart where the market has previously reversed its direction due to changes in supply and demand. Traders should look for strong areas of buying or selling pressure that have held up over time, indicating the presence of a significant supply or demand zone. 2. Watch for price reversals. Once traders have identified potential trading zones, they should watch for price reversals. This means looking for signs of a shift in market sentiment, such as a strong bullish or bearish candlestick pattern. Traders can also use other technical indicators to confirm price reversals, such as the moving average or the relative strength index, RSI. 3. Enter or exit trades based on price action. Finally, traders should enter or exit trades based on price action. This means waiting for confirmation that the market is indeed reversing its direction and then taking a position based on the new trend. Traders should set stop-loss orders to manage risk and take profit orders to lock in profits. Conclusion. Kai bao kung va kao lamo trong nun kai bao han dong jia tut nyat cho kak na gao dik v no tap trung bao kai naim ko ban nyat trong gao dik, kung va kao. Bang cash zak din kak khu vuch gao dik ko zak suat sao va theo doi su dao naguak jia. Kak na gao dik ko the kai thien hu suat gao dik kua ho va dat duok loi enwan sao hun. Noi ban dang tim cash kai thiem chien luok gao dik kua min. Hay kan niak them kai bao kung va kao bao bo kong ku kua min.